Hi, it's Dre Griggs of Obsidian Wisdom. Today we answer the question, are we in a recession? And if we are, what should I do about it? For those that are retiring, for those that are investing, for those that just have their money somewhere that isn't quite 100% safe, you are probably looking at the news and seeing all these articles where people are talking about the recession. In fact, just on my LinkedIn this morning, you see this article written by Riva Gold, and it's talking about the US growth fears and how it's jolting a lot of concerns in the market. And you'll see what she does is she lists a few indicators that normally are signs that we're in a recession. So we'll go through a few of those and then we will make the decision ourselves. So you see the VIX Index, that's known as the Wall Street's fear gauge, that is at its highest level in over 4 years. And you'll see while the S&P 500 and the NASDAQ 100 were down to their 2-year lows, which is normally going to be a concerning sign for us. We know that the data just showed the US growth market was a lot weaker than what was anticipated. We know the interest rates are still pretty high and that they're trying to aim for this soft landing. A lot of people are now worried about whether this soft landing will be a hard landing. For those that aren't familiar, a soft landing is a very fancy way of saying that we're at a time where we have high inflation and very low unemployment. And because of that, everyone has a whole bunch of money and people are spending out of control. So what the Fed does is they start raising the interest rates. So that way, unfortunately, yes, some people start losing their jobs because the money is not as easily accessible as it was when rates were very, very low. Then you also would take a look at the inflation. So inflation goes down because we're not able to spend as much. As people lose jobs, there's less money in the market, and people without jobs are more willing to take lower paying jobs when they go back into the market. So with that being said, a soft landing is when I get our inflation right around that 2 to 3%. I get our unemployment, about 5%. I'm not trying to get anything too crazy. I'm not trying to jump us up to 10%. And then if I can get everything around those very nice numbers, what I'll do is I'll start lowering interest rates again, and then we'll have a soft landing. When we talk about a hard landing, that's basically when we lower rates a little bit too late. So we know that when you raise rates, it causes people to lose their jobs and it causes people to spend less money. As a result, we go into recession. If you don't raise the rates at the right time, we go into a depression. That would be considered a very hard landing or a very strong recession like the 2008 Great Recession. These are considered hard landings where the general consensus is the Fed didn't do a really good job. In 2008, we contribute a lot of what happened to the fact that there just wasn't any credit available. All the money was dried up. Banks weren't giving any loans. The Fed wasn't doing anything. All of a sudden, there was no money. And so we ended up going into a very deep recession. That's when the Fed said, okay, we're going to lower interest rates to like 0%. We're going to start printing money every single day. Of course, they call it quantitative easing so that you don't know that that's what they're doing. But that's another topic for another day. And with that information in mind, you'll even see that today the Fed president of Chicago said, hey, look, if the economy goes south really, really quickly, the Fed will step in and fix it, which is just what we talked about. They're either going to print money, lower interest rates, or both. And then you'll look at some of the sectors. So you'll see that the Magnificent Seven, these are basically the 7 AI stocks. It's like Microsoft, NVIDIA, Google, Meta, Apple. These are just the stocks that are considered to be on the very front of the AI revolution. And as AI continues to become commonplace in the average person's life, most people believe that these 7 companies are going to be the companies that take in the majority of the revenue from that. And you can see that they had their worst day on record. Now, part of that is because when you start cutting back, where's the first place as a company you cut back? And most of the time, that's going to be your research and development. Well, that's basically going to be the whole AI revolution. We are spending a lot of money on growing this industry. And so if companies have to cut back on the research and development, then that would mean that all of the belief I had in these stocks is not going to come to fruition very quickly. You'll also see that Japan's index dropped 12%, and that's the steepest drop since 1987, a Black Monday event. All of these are leading to concerns. You keep going, we have Business Insider. They talk about 2 recession indicators that have a pretty good track record of saying whether or not we're in a recession. And so the first one is called the Sahm Rule. And all this says is the US economy is in a downturn when the 3-month moving average of unemployment rate rises by 0.5% from its 12-month average. You might say, okay, Dre, well, how have we been doing? Well, we've been doing worse than that. So you'll see that on Friday, the unemployment rate rose to 4.3% in July, and that was up from 4.1% in June and from the recent lows of 3.4% in April of 2023. And so you can see as far as the Sahm Rule is concerned, we're already in a recession. Now, everybody doesn't like the Sahm Rule, and the main reason people don't like the Sahm Rule is it doesn't keep a track of rising labor participation. Just means how many people are actually trying to get a job. As a result, that could actually raise the unemployment rate, and it has nothing to do with necessarily being in a recession. If you're someone who falls into that camp, what we'll normally do is we'll look at the year over year growth in unemployed persons. But even that number suggests that we're in a recession. So the number of unemployed people has now grown to 14.5% year over year. And over the last 11 times that this has happened, the economy has been in a recession. So, as far as those two indicators are concerned, we are in a recession as well. Now, I don't really have to go into a lot more detail, but you can see that there's a lot of fear that is going on where people are writing articles talking about the Wall Street plunges as US recession fears jolt the markets. You'll see that the Dow closes nearly 500 points lower Thursday as investors' recession fears awaken. You'll see that we have unfailing recession signal ignite stock plunge, where you'll see there's already a lot of people who feel that we are in a recession and for good reason. So the question becomes, okay, Dre, if we're in a recession, what do I do about it? You basically have three choices when it comes to your investments in the stock market. Number one is you don't do anything at all. You've already built a diversified portfolio, and I'll put a link to another video where I go in more detail about some of these consistent portfolios that work really well through a variety of recessionary environments. But long story short is if I've already built my portfolio to perform well in a variety of economic environments, then I don't really need to change anything. I know that a portion of my portfolio is going to do great in a recession. I know that a portion of my portfolio is going to do wonderful in times of economic growth, so I don't change anything. The second choice is I take positions in the stock market that are a little bit more defensive. So normally when you're in a recession, there's three sectors that perform pretty well. And the thought process is if I don't have a lot of money, I have to spend my money on certain things no matter what. And what are some of those things that would come to mind? Well, you would think of healthcare. We always have to go see the doctor. If I'm sick or have a surgery or some event that is impacting my health, that is not something I can wait for a happier economic time. That is something I have to deal with right now. And as a result, the healthcare sector normally performs pretty well, even in times of a recession. The second is going to be considered consumer staples. That is just the idea that I have to spend my money on food and water and things like that. And to no surprise, you'll find that the last two recessions, Walmart has done exceptionally well. Walmart has outperformed the S&P 500 during the last two recessions. And if you think about it, when I'm running out of money, if I have to be very mindful of how I'm spending my money, whether it's I'm getting unemployment or whether I had to take a lower paying job, I'm probably going to go to places like Walmart. We still got to eat. I still have to get my food. And so as a result, Walmart does really well during these times of economic recessions. And then the third is going to be utilities. Normally people have to use their energy. We got to pay our light bill. If I only have a set amount of money and I don't know what to do with it, I'm going to make sure I have food on my table and I'm going to make sure that my lights are on. These are two things that I can't really go without. So normally these sectors perform really well. And so you can look at the energy sector as a place to invest your stocks to make sure that you're okay during these times of recession. There are some who would take all of their money out of the stock market where they're going to invest in bonds or maybe money market accounts, other safe conservative investments, and they're going to wait on the sideline while they wait for the market to recover. The overall concern with this is it's really hard to time the market that precisely. And what I mean is normally if you look, and I'll probably put a chart up where you'll see basically over a span of 20 years that if you missed the best days of stock performance, you would end up with almost a flat performance as far as the return on your investment. Where if you're able to maintain your investments through these times of economic growth and economic decline, you would have outperformed someone who took all their money and placed it out of the stock market, but they missed that day of growth. And the reason is pretty straightforward. Normally what happens if we go into a recession, eventually the government, the Fed, someone will do something. They will lower interest rates. They will print money. They will announce a package where something will happen. And then everybody starts buying the stocks back. So they shoot up. Well, because you don't have an algorithm performing the trades, or because you don't have that insider information that you notice that some of our Congress people have, where they were selling stocks because they were doing the investigations before COVID happened, it's hard for the average person to be able to have the information to jump in at the right time. We're not on those phone calls. We're not reaching out. We don't have those connections to talk to people. We don't have people on the ground all throughout the world. And as a result, it ends up being a tough time for us where we end up missing some of that growth, and it has a negative impact on our overall portfolio's performance. Now, the third and final choice, which is a little bit more of an advanced strategy, is the idea that I have my on sale list. And it's just as it sounds, where if we were in the real estate market and prices went down, we would be very excited. We'd be like, oh my gosh, the prices have gone down. I'm going to go buy this property because I know that the value is going to go up. I know that it's worth more than the current price it is right now. And so when you see a sale at a store or in real estate or a business, I mean, a variety of different industries, we're very excited to jump in at that opportunity to get something of greater value at a lower price. We don't feel that comfortable in the stock market. When the prices go down, our first thought is often to sell everything because we're watching ourselves lose value. We're very nervous about the stock market. We don't know where it's going to go. But if you have this list where you go through and you decide what the value of a company is, then you can say, whenever the value of this company is below that number, I'm going to buy that stock. Because right now it's on the hype train and the price of that stock is higher than the value I perceive the company to be worth. And I'll go through one of the examples from one of the reports that I receive, and it's actually from a gentleman at Morningstar, so Dan, and he talks about Coca-Cola. So let's go through this example and I'll give you a little bit of information along the way. And so what you'll see is they took the Coca-Cola second quarter earnings report from July 23rd, and then they went through and analyzed all of the fundamentals, the data. How much debt do we have? How much earnings do we have? The revenue that we have? Where's the money coming from? How healthy is the company? The overall performance of the management team? All of these different things. And then they had a fair market estimate of $60. Now, Coca-Cola currently is at $68 and some change. So we know that it is currently overvalued from Dan's estimation of its value of $60. And so what you would do is you would have a list of 10 to 30 stocks that you really, really like, companies that you've always heard are a great buy, and they're just not at the right price. Because a lot of the times the price that we pay determines the value that we receive. If I was to go buy a house that was worth $300,000 for $200,000, I'm going to feel really good about that purchase. If I bought a house that was $300,000 for $450,000, well, I'm not going to feel as good about that purchase. Now, maybe in the perfect location, it may be the once in a lifetime opportunity where no one ever sells in that area. There are other things that we can consider that make something a better long-term choice, but just based purely on the numbers, we would say, yeah, I overpaid for that. And as a result, the value versus price isn't really working for me. And now Morningstar, they have a rating system where they give them different star ratings. We're not really concerned about that because I'm not telling you to go buy Coca-Cola. But what I'm trying to do is show you how to find the fair market value of something, and then we can go from there. Now, I did put together a video where you can use a variety of metrics to determine the value of a stock, and I'll put a link to that video for you so that you can put this list together for something that you're interested in. But so we're saying, okay, it's at $60, so let's go ahead and let's start going through the numbers. And they say, hey, what we thought of Coca-Cola's Q2 earnings. So it says that they had a strong second quarter earnings and raised its 2024 outlook. So it means that it overperformed, right? And so as a result, we feel really good about it. Organic sales rose 15%, and adjusted EPS, which is earning per shares, was up 7%. Earnings per share is just saying for every dollar that I give in price, how much do I receive back in earnings? In the S&P 500 as an average is about 22, which means that for every $22 that I invest in the stock market, I on average will receive a dollar back in earnings. And so earnings per share was up 7%. You see that the volume held up 2% for the quarter, even after 9% price mix, which we attribute to the resilient trends of Coca-Cola's consumer-centric innovations, right? So they have their zero sugar recipes, they reformulated Fanta and Sprite, and then returnable bottles, just all things that they've done to try to stay with the current economic climate, which is a lot of people are doing keto and people are watching the sugar intake. So as a result, they're moving with the overall climate. And then people that didn't like Fantas and Sprites, they adjusted those recipes as well. And then people are a little bit more conscious as far as recycling and being energy efficient, green energy. So they have returnable bottles. All these things Coca-Cola is trying to do, as well as the purchases of water companies and energy drinks and different things as they try to move with the overall climate. Now they will say, okay, well, if Coca-Cola is around $68, I believe it should be around $60. And so you would have your on sale watch list. And as soon as it goes below $60, you would buy the stock because that is what I believe it's valued at. You might buy it a little bit before that. Warren Buffett talks about the idea of buying really good companies at a fair price where it doesn't have to be on sale all the time if it's a really good company and you have a long-term perspective. So they talk about the economic moat, very fancy way of saying that this company has something that you cannot just replicate in the market. And most people will say Coca-Cola has a very unique taste. And as a result, if you're someone who's a strong Coke fan versus Pepsi, then that means that you would say, all right, I'm going to buy Coke. And because people buy Coke, that is their moat. And because of this moat, Coke is able to charge more than the average carbonated beverage. And so they have better margins than a lot of these other sodas out there. And that's what we're looking at. Same with Apple, same with Disney Plus, all of this stuff where I can't make a Star Wars movie without having the rights to Star Wars. I can't use Marvel characters without having the rights to the Marvel movies. And as a result, that becomes your moat. And so that is the moat that we're talking about, just something that cannot be easily replaced. That if I was to open a soda company today, I could not have it taste exactly like Coca-Cola. That's their secret recipe. Then we look at your financial strength, which is also a great metric when determining whether a company is doing well. And you'll see that we use the net debt, which is just my long and short term debt minus the cash that I have on hand. So that's my net debt. Then we have our adjusted EBITDA, and EBITDA is just your earnings before interest, taxes, depreciation, and amortization. And when we say adjusted, what we're going to do is we're going to take out these one off events. So if they had a whole bunch of money come in, that's going to be a one time event, then we're going to remove that. If they wrote off a whole bunch of debt and that was a one time event, we're going to remove that. Where we're just going to look at some of these funny maths that we see in these financial statements, and then we're going to go ahead and take a look at that. And so with the net debt to adjusted EBITDA, that is at 2 times in 2023, which is within its long-term target of 2 to 2.5, which is a very fancy way of just saying how many years would it take the company to be able to pay off all of its debt with its adjusted EBITDA. And 2 years is a pretty good number. So that means that they're a pretty financially strong company. And then you also see up here, it says the company has 15.2 billion in cash and short-term investments as of March 2024. You see that they have 4.2 billion in backup lines of credit for general purpose use and a well-established commercial paper program in the US, letting it consistently access short-term funding at low rates. All we're saying is that they have a lot of money on hand, they have great credit so they can get more money, and they already have their relationships established. What the good companies will do is in times of economic prosperity, they will go and take out a loan to invest because they can get the loan at 1% or a really good interest rate. And if they're able to return a 5% on that investment, well, that's a really good investment. Oftentimes, what smaller companies will do is they will say, well, I'm just going to continue using my cash. I'm not going to take out any loans. And if we find ourselves in trouble, then we can go try to take out a loan. Well, you and I know, go try to get a loan when you've lost your job. That's going to be really hard to get approved for a loan. Instead, if you get approved for the loan when you have great cash flows, but you just don't necessarily need the money at that time, that's actually the better opportunity for many people where you can take the money and find a really good opportunity to invest and get a return higher than the rate at which you borrowed the money. Another factor you want to consider when estimating the price of a stock is normally is risk and uncertainty. As we're in retirement, because we're using the money, we don't necessarily want to take as much risk. We're moving into a capital preservation where we want to maintain the money that we have while, yes, keeping up with inflation and growing it. So we need to know how much risk we're taking on. Now, one of those things is our price consideration. So a part of the value of the stock is how much they can charge as a company. And as a result, you would normally look at what things would cause them to have to lower the prices, if anything at all. And so you'll see that in the United States, we don't have as much of an issue because there's a lot of small local bottlers. And as a result, Coca-Cola is able to tell them, hey, look, I understand that the price has gone up, but I'm not going to raise the price of my Coke. I'm going to pay you the same amount and you're going to take this relationship because even though you're going to make less per bottle, you're going to still make a lot of money because I'm Coca-Cola. And so they don't have to worry about that from a pricing perspective in the United States. But in the emerging markets where 2/3 of the revenue is generated, we actually see that that is something that they may have to be keeping in mind. And what we're saying is Coca-Cola has much larger bottlers. They're not small mom and Coke operations. And because they have larger bottlers, they actually are in a position to negotiate. These bottlers are like, hey, look, Coca-Cola, we appreciate everything that you're doing with us, but you're actually only 10% of the revenue that we generate. So we're going to need to increase the prices that we charge you. And as a result, Coca-Cola is now set with the choice, do I increase the price that I charge my consumers, or do we eat our costs and maintain the same prices, but because our cost is higher, we're actually decreasing our profits? The other thing that you would look at is Coca-Cola, while they are an American company, while they are a huge American company, because over 2/3 of their revenue and profits is being generated in international markets, that basically means that Coca-Cola is almost like a foreign investment, where you have to take into consideration the countries that they're in. But at the same time, Coca-Cola is a very large player. They're a very strong player, and you're probably still going to be relatively safe. But when you're dealing with international markets, some of the things that you have to deal with is, of course, the macroeconomic environment of the country. Do they have new policies that they're enacting? Are they in wars? Do they have other issues, regulatory landscapes? Are they changing laws? Do they make Coca-Cola illegal in their country? Currency fluctuations where the revenue being generated is nice over there, but when you turn it into US dollar, it's not nice anymore. Versus when you're just dealing with an American company with an American consumer base, and then you don't have to take a lot of that extra stuff into consideration. This is just something that you want to consider. And at the end of the day, because evaluating a stock's price is more of an art than a science, we'll all give different weights to the information that we just went over. So the people who say that this is a buy, they'll say, look, they have great bottling relationships in underpenetrated emerging markets, which is a very fancy way of saying that they don't have as much of a market share over there. So they're going to continue growing, where it may even be more than 2/3, and that they have the class of recipes and new products tailored to local tastes, where they basically make some adjustments. If you've ever seen the way McDonald's is when you visited in other places, McDonald's changes their menus based on the local taste. So Coca-Cola is already doing that. So that's a great reason to buy it. They invest heavily in digitized supply chain and data analytics to have a better aligned Coke and its bottlers and product planning, manufacturing, and go-to market strategy. Just means that they understand their customer. And as Costa recovers from pandemic related disruptions, it should help Coke gain a firmer footing in the coffee category and provide more consumer insights given its global footprint. Again, we're just saying that Coca-Cola is in a great position to grow significantly. And if you believe that's going to happen, even with everything else that we went over, then Coca-Cola is a great buy for you around that $60 price, or even now at 68, if you believe it's going to go up to $80, $90. Now, of course, everybody doesn't think it's a good buy. When you look at the bears, the people who would say, let's sell Coca-Cola, they would say, hey, look, secular headwinds and carbonated soft drink demands in developed markets challenge Coke's long-term growth outlook. More and more people are saying carbonated drink sodas are not good for you, and some places are actually banning them. So that's the one thing that they're talking about there. And the company's brand portfolio and product lineup in non-sparkling categories are less robust, and heavy investments are needed to bolster its competitive position. A very fancy way of saying that a lot of these other brands inside of the Coca-Cola umbrella are not as well known, are not as well liked, and don't have as much market share. As a result, Coca-Cola is going to have to spend a lot of money to generate a little bit of revenue. And do we have the time to allow Coca-Cola to invest these profits this way while we wait on this value of the stock and the return of our investment? And so those analysts would say no, that it's going to take a pretty long time and it doesn't make sense for you to buy Coca-Cola now. And then they'll say with 2/3 of its revenue for international markets, Coke faces constant currency fluctuation that drive volatilities in reported earnings, which is, as we mentioned, they could be selling gangbusters in a different country, but once you turn it into US dollar, they lose 20% of their profits because of the currency exchange. And so as a result, those people would say no. What you're basically saying is we're going to take this information. This is the information that we would normally look at to decide whether a company makes sense for us to invest in, almost like Shark Tank. Well, then if you do that, you would have this list of companies, you go through this exercise, and then you would put it together. It may take you a little bit of time to put it together, or maybe this recession, you're not ready for it because you're busy, you don't have the time. And maybe the next recession, you'll say, okay, I'm going to go through these stocks and I'm going to start putting my number together. And then I'm going to look at it every quarter. And then as soon as these stocks go on sale in the next recession, I'm going to buy these stocks. Now, it goes without saying, this is the most advanced of the three strategies, but these are the three strategies that you would be looking at if you're going into recession. Now, based on the numbers and the information I've looked at, I would say, yes, we're going into a recession because that is what the Fed planned all along. That's why we raised interest rates. That's why companies are laying people off. That was the whole plan all along. The question isn't whether we're going into recession. The answer is yes. As a result, we're shifting from an employee's market to an employer's market. And that's what the Fed always had planned. And then when you take into consideration that a lot of those indicators that I went over today are lagging indicators, which means that they show up after you've already kind of been in a recession, which means it's more likely that we're going to have tougher times in the near future because they're lagging indicators, which then leaves you with the choice of what do I do? You have those three choices we mentioned. One is you already have a diversified portfolio that is going to get you consistent returns in a variety of economic climates, so you don't really have to do anything except look at your asset allocation and see whether you need to make any adjustments to your portfolio just to make sure that it's aligned with the asset allocation that you originally intended. And I'll put a link to another video where we talk about different rebalancing strategies to make sure that you maintain the proper asset allocation. The second option is I shift from markets that don't perform well during times of recessions, like obviously leisure. People don't take leisurely trips in recessions. And then normally it's going to be small cap companies because they need the money to reinvest in their company. And as you've probably seen, when we are in a recession, the credit shrinks where it's harder to get approved for loans because there's more and more people defaulting on their loans. Because of that, these small companies, their capital ends up drying up because they just don't have access to it anymore. Then the third option is one that we just went over, where you basically put this sell list together. You have your 30 favorite stocks that you love, the price that you believe they're worth, the price that they're currently at, and the price that you're willing to pay to buy it. And then you would look at that list. And as we go into recession, as you notice some things on your buy list go down, you will start investing in those companies, which is a great opportunity for many of us. That's why in every recession, there are people who end up losing a lot. That's true. But there are also people who end up making a lot because they have the plan in place and they just enact the plan.